Welcome to Total Money Management. We're back and it's September. I'm back with Tom and Steve. How you doing, gentlemen?
Good.
Very well. That was an electric intro.
I'm feeling
Yeah, it was, wasn't it?
I've got some sexy
dude.
beast in me.
See, that's
Sorry?
what does it, mate. That's what does it.
Just
What did you say?
Hold the drop of sexy beast up so people
Oh,
can see
the
it.
wine.
Right, what do we got? Warren Buffett's 95. How long do you reckon he's got?
You know what? I was thinking when I was reading this, I remember saying happy birthday was and I can't believe it's a year ago.
Yeah. Yep.
Like we did
But
this.
95, what do you reckon? 2 years?
No, I reckon he'll get to 100. He's got enough money.
You know,
I don't know. It's all the old dudes who don't eat properly that seem to last the longest.
Yeah, but he's
You know.
got heaps of money, so that there's a real correlation there. It's like the Queen, right? The Queen got to she got to 99, didn't she?
Yeah, she didn't quite
The Queen
get there.
mum got to 100, I think, didn't she?
Yeah,
But she was just basically full of gin.
yeah.
I'm not kidding.
That's the trick.
Yeah.
Oh, there you go.
kidding.
Not
Yeah,
advice.
No, there's an Eastern philosophy, drunken monkey, which is basically you just wanted the countryside drunk all the time.
Yeah,
And because you relax, right? And it's just like, yeah, everything's good.
yeah.
And it's not as if you're like, oh, I got to go to work.
No, he's going to have the best of the best doctors, surgeons, physios, all sorts of stuff. So,
He's still 95.
and I want to
yeah.
see I want to see how he handles the bear market.
Well,
I'm
if-
curious.
that's
with,
what I'm
with
saying.
grace and elegance,
He
mate.
may not make it.
Yeah,
The way this bloody market's going, it'll be 2035 before it actually crashes.
So he's 95. He's got 350 bill cash.
US.
US. It's
That's
not a
lot.
bad spot.
Yeah. Not bad for a bloke who likes
That's a good
coke
analysis.
He's done all right.
Coke and
He's done
steak.
all right.
Coke and steak. There you
What else
go.
are we talking about? China market. It's
Well,
up
they're leveraging
35% so far.
Yeah, it's taken off.
was that not an "I told you so" moment from a
Oh,
year
big time.
ago?
I think it's a continued told you
A
so.
little bit, yeah. But it's interesting, like it just goes to show the Chinese economy is not doing that well,
No,
right? And it's always, we talk about making the connection between the stock market and the economy. It's just crazy.
But it was very undervalued.
Look, that's true, Tom. It's true. But it's still, the economy's still not going that well. It's usually what the studies show. You should I think it was it's in a book called What Works on Wall Street, right? And it was written a long time ago. But basically what they said was you buy value stocks 6 months after they've bottomed, and that's when
you catch the growth in them.
that's when you get the good bit, right? So, that might apply to countries.
You've just got to know when they're bottomed.
Well, no, because it bottoms and then it turns up, right? And it may be 2 or 3 months. But the sort of point they're emphasising is you sort of wait for it to bottom first and then, let it go up. You can use technical analysis for that stuff, right? 50-day moving average or even a 200-day
200
move.
days are good. Yeah.
200-day moving average. Because once it gets a bit of momentum and the narrative changes, then you sort of think, okay, well, it's probably worth getting in. Funnily enough, a lot of people, if it goes up a lot in a short space of time, a lot of people go, oh, have I missed it? Like it goes up 15% in 3 months and people think, it's too late. I should have got in. Yeah. And it's like, hang on, it could go up another 35 or 40%.
Especially it's undervalued, yeah.
Yeah. But it's just those tricks, that you sort of play on yourself.
Yeah. The stock market's good for bringing that out of people.
Oh, absolutely, 100%.
It's so easy when you're looking in hindsight and it's moved 100%. You're like, oh, I wish I bought
Yeah,
that.
yeah.
But when there's no other candlesticks on the chart,
Yeah.
it's really hard.
I always, because I look at it all day, sort of every day, and I look at companies and just read stuff, and I always see things where I go, oh, man, that's gone up 45%. I had a look at that, but I might have just read about it, but not gone, oh, I'm going to investigate that further. Like it's just a sort of recognition bias, oh yeah, I read about that. Oh, I should have jumped on it, right?
But then again, you read about everything.
But that's what I mean, that's what I mean. Everything I read, I sort of go, oh, what about that? Oh, what about that?
Well, Steve's completed reading. That's why.
Mate.
Yes.
So we got the Aussie economy. So it shows signs of life a little bit.
Yeah, growth's gone up. It was a bit of a surprise, actually. Growth's gone up to 0.8 from 1.4. So yeah, not exactly. Let's calm down. We're not there. We're not there yet. But the more interesting thing, I suppose, was that the stock market, there was a lot of earnings announcements this week. So there was a bit of volatility and stuff.
We had a flash down and then back up again.
Yeah, a bit of movement. But like we put an article in there. Share prices go wild while earnings have basically done nothing.
Yeah.
And it is a little bit true that, like if you look at the overall economy, it's hard for a company to outperform the economy, for an extended period of time. And if the economy's going at 1.8, it's not like, you're going to be making bucket loads because the economy's not growing that much. Right. So, and there'll be, I know some of the tech companies have done really well. But again, a lot of that vibe is from the US, and that's why we talk about, when we talk about sectors and you say, well, if you look at like telecoms, for example, right, and you see there's a few telecom companies that are cheap. If you look globally, you see that they're generally all cheap. At the same time. And it's like
in comparison to other things.
Yeah. It's like oil at the moment, right? The oil price is low. And you look at all the oil stocks in Italy's got Eni, right? That's their big producer. The French have got Total. England's got BP and Shell. America's got Chevron. If you look at them all, they're all really quite cheap, right? And that's where I think that's a really good strategy because to my way of thinking, what I'm doing is saying, well, it's not really for example, it's not really Chevron's problem. The problem is the whole industry. So therefore, if the whole industry improves, Chevron should improve, and therefore I'll get a good return.
Yeah.
Yeah, I mean, and oil's not going anywhere, is it?
No, not yet. But keep faith, son.
It's the whole thing, like Warren Buffett, right? Look for the cheap stuff and look for the big, good, old, tried and tested companies within that patch.
Yep, the dividend payers.
Yep. And then just wait.
Yep. Just, Charlie Munger, rest in peace, Charlie. Charlie said, what did he say? We make our money by a technique called assiduity or something. And it's like, what's that? And he said, by sitting on our ass.
Assiduity.
Yeah, and just sort of, by saying, it's just, there's an old saying, I think, if you buy right, you've done, the job's half done. So because, again, if you buy low and you get a really big compound annual return, well, there's no reason to sell it if you're making 12 or 13 a year, right? Every year, because that's a great return. Whereas if you buy something and it's making 4 compound, it's not, you can fast forward, but it's unlikely that it's going to make 15 compound for the next 10 years.
4 sounds like a waste of time.
Well, yeah, but that's the dollar cost averaging stuff, right?
Yeah.
They're like, just keep buying it. And
yeah, well, you keep buying it on the way up, keep buying it on the way down, and you get the average.
Yeah.
In other news, well, the Oz, not other news, the Oz economy is still booming. Well, the Oz property market is still booming.
Yes.
Sorry.
Thanks,
so
Albo.
There's not really much to talk about there other than it's crazy.
Booming prices.
But in New Zealand, it's trending down.
Now, there's another story. You have a look at that. That's the prices in New Zealand are coming down quite substantially, and that's why I think it's also happening in Canada, and the US is starting to turn down.
Well, New Zealand, Canada, Australia are the top 3.
Yep. So, Australia can probably hang on for a little bit longer, but that point aside, it's just crazy trying to buy property. And I think a lot of the complaints, I think, and I might have said this before, I think a lot of the complaints about people with property is they feel like they're missing out on a chance to make money, right?
It makes sense to them. Like if you talk to the average Joe on the street about property, it makes sense because it's most of their lifetime property has gone up.
Yes.
Whereas the stock market can seem a little bit harder to understand.
Yeah.
Because it's so vast and magical.
And it's got volatility and all that stuff. Yeah, I would agree with that. But I just think it's important to decipher because when you get FOMO, you're a chance of making a big mistake.
Yeah.
Right. And I sort of look at property now and think there's a lot of people who are thinking, oh, all those old bastards are getting rich and I'm going to be poor forever. And as I've said before, I don't think that's going to be the case. Right. The market will turn. You just can't see it. It's like the stock market, right? You can't see when it's going to turn down. You can't see when it's going to boom, but it will do it, right? Because that's the way cycles work. But the feeling is in property at the moment that the young people feel like they're missing out on a lazy 200,000 or 300,000, right? So the idea is, we'll just get a property and you get rich.
Well, there's so much positive marketing. Every single person's a property buyer's agent.
Yeah.
Everyone's making money from it. And most people don't realize that they're actually not making money from the property most of the time. They're making money from selling whatever they're shilling online.
Yeah. They're making more money from flogging property
information.
Yeah. Or like you say, like I'll help you buy 25 million properties and, you can be a delivery person. It's like, okay. And let's be honest, it's just leverage.
Yeah.
It's just batting up shitloads of dosh. Yeah. Right?
It's all good and well getting in, but if you're stuck when the tide goes out.
Well, that's the hard part. At least with shares, you can get out on a click.
Yeah.
Right? You can just go, it's driving me crazy, click, and it's done with, right? And the cash is in your bank in 2 days.
That can be good and bad, depending if you're emotional.
No, fair call.
Like the amount of people that will like panic sell when things start dropping.
Yeah.
And then panic buy again.
Yeah.
When things start recovering, only to realize that's a bear market rally.
Yep.
It's going to fall again.
Yeah.
So they're just compounding the opposite direction.
Yeah, their errors. Yeah, that's true. That's true. I just, like I say, I'm not against property, but when things are just crazy expensive, you've got to be, you've got to have a little bit of logic and say, well, what's the chances of it performing over the next 25 years like the last 25? And it's like virtually zero. I mean, population demographics are terrible. There's just a whole raft of things where you look at it, 14 times income, all that sort of stuff, and just go, look, best of luck, but I don't think it's going to. The problem will be you guys will buy a property and then the next 20 years it'll go nowhere.
Yeah, that's
right?
what I'm
interest
worried
rates will be at 9%.
I walked into a conversation a couple of days ago and there's 2 or 3 people sat around the table saying, property in 15 years, like it's going to be at least $5 million to buy your average house in Brisbane. And it just took everything in me to not say anything. I was like, tell me more. What do you think of that?
Well, it's all you've got to do, and this is always the critical bit, do the numbers, right? We're going to talk about AI in a few weeks on one of our specials, and you do the numbers on things like revenue and cost and, the energy and all that sort of stuff. And it doesn't make sense, right? Pardon the pun. At the moment, it's just a really, really long way from being profitable, right? And you could argue and say, yeah, but Steve, it'll be they'll work it up in the future. Okay, maybe, but the stuff I'm looking at, it's just like, man, that's horrible, right? And it just doesn't make any sense to me. But there'll be 2 or 3 AI companies. But at this point in the cycle, it's like, man, I don't know who it's going to be. Like it could be Chat, it could be Grok, it could be, Google's one. Is it Nano Banana?
There's like a Claude or something.
I have no idea. All I know is apparently Grok is racist.
Well, yeah. See, but that was one of
Elon's AI.
Yeah. Well, apparently when you use Grok, it heavily relies on Elon's tweets and stuff.
Yeah, right.
So
he's the source of truth.
I did it a couple of weeks ago. I said to it, this is what's Microsoft's one? Copilot.
Yeah.
Copilot. Anyway, I put in there and I said, if I started with this amount of money and I had this amount of money in cash and I rebalanced like this, how long would it take me to run out of money? Right? And it came back and it said 171 days or something. And I thought, oh, right, okay. So then it you know how it tells you the reasoning?
Yeah.
Yeah.
Okay. So I sort of look at it, sort of flick it and go, yeah, cool, okay. Then yesterday I wanted to use it and I looked at it and thought, okay, I'll just read through this. When I read through it, the first line calculation was completely wrong. Yeah, right. So I said if you had 100 in stock and 100 in cash and the stock market fell 1% per day and I rebalanced back to 50-50, how long would it take before I run out of money? And I think it said like 171 days or something, right? And I went, oh, okay. Then I looked at the first line that said, paraphrasing it, but it said, yeah, your stock value would fall to 99,000 and your cash value would be 100,500. And it's like, no, they both should be 99,500, right? And that's what I'm saying. When you look at stuff like that and go, hang on, you want me to pay $30 a month for this garbage that I've got to double check? I might as well just do it by myself anyway.
Get a calculator of $10.
Well, but see, that's the problem. The problem is, yeah, you can do that, but you end up having to check it anyway. So it's like full self-driving, except we've got the guy who's monitoring it in the passenger seat. It's like, okay, I'm sorry, what's the purpose of calling that full self-driving? It's nowhere near it.
Yeah. There was someone was telling me a story yesterday about self-driving in America, and he's American, he's here now. And he was saying, oh yeah, I used it in my hometown, I've never used it before. And they got stuck. There was apparently 5 or 6 self-driving cars all stuck in a line.
Oh, I think I saw this. And none of them could move.
And none of them could move. And they all had passengers in, and they all locked their doors so no one could get out.
Yep.
And they all started honking at each other.
Yeah.
Like, well, AI honking shows him that's emotion. Like they're getting frustrated that they can't move.
It's crazy.
And they apparently all were waiting for they can calculate when this certain fast charger in this town, like it's about 2 minutes quicker than the other fast chargers.
Right.
So there's 10 fast chargers, they're all waiting for one, and there's 9 other fast chargers
that are doing
nothing.
Nothing, yeah.
And they're all honking at each other to try and get through. It's just
That's what I mean. This is why I say if you look at the capital cycle of AI, or you look at AI and use our capital cycle stuff, right? That's where it fits it perfectly, right? Heaps of hype, heaps of potential. That's all they're talking about. It's going to take over the world. You got a, what do you call it? The halo effect with Sam Altman, right? He's the cheerleader and the face of AI, and then it starts to turn, right? And I don't think we're there yet in the mainstream. I read, I'm still reading articles this week about, how we're going to do, I saw something on YouTube which was the only 5 jobs that'll be left by 2030 or something. I mean, you just look at that and go, well, that's bullshit. That's ridiculous. Now, I know it's a YouTube headline, but
AI probably built that video.
Absolutely.
Yeah.
But the point being, you get carried away with it, right? And people are talking about it as if it's going to take over the world, and you've got robots and all this sort of stuff, right? And most of it falls on its bum because it's just overhyped.
Yeah.
We could easily be, but here's the thing, right? We're at a cape of 39 or almost. We've been at 44 before. We could easily spend the next 2 or 3 years in the late stage bubble almost, where AI just takes over even more, and then it goes to 44, 45 or whatever it might be, and we see the downside. We're talking about this now, but we still might have 2 or 3 years in it.
Yeah, absolutely. Yeah. That's what I mean. The general mainstream is still AI is going to take over the world.
But then it'll be a black swan event, and no one could have ever seen the market crash coming.
Well, yeah. But remember last week we said Sam Altman said, AI is a bubble.
Yeah.
But I think he's doing that. As I said, I think he's doing that to cover his ass.
We're going to cover a lot of this stuff in the special.
Yes.
Yeah. Keep us on track, Tommy. What's in the lesson of the week?
Well, we've got a chart here, compounding versus drawdowns. And it's just kind of driving home that point why it's just as important to avoid losses as it is to make profit.
Yeah, the sequence of returns matters.
100%.
Yeah. Yes.
Which is why we keep banging on about timing. Is why we keep, throwing stones at DCA.
Yes, absolutely. What I wanted to show there was this idea of, again, the arithmetic average versus the geometric average, and just continuing on from the last couple of weeks where we talked about that Vanguard chart.
Yeah.
And then last week we did the range of returns. And so this one is sort of the next step in saying when you have one bad year, that really smashes the portfolio, right? And it's really, really important because when you look at the average return, you tend to think of it as multiplication, right? But it's not. To do that, you've got to look at the geometric average, right? But what I wanted to show here is something really important. So, Dan, if you're listening, put the chart up. What you've got is you've got a steady portfolio and a volatile portfolio, right? So this is how volatility eats away at returns.
Before we get into it, can you give an example of what a steady portfolio might be?
Yeah, well, the steady portfolio, as you see there, is 5 positive years in a row.
What would it be comprised of, though?
Well, it's just the index.
Yeah.
Right?
Gotcha.
All I'm saying is the return's 11, 9, 3, 11, 4, right?
Yep.
If you look at the volatile portfolio, it's 28, which is really great. Then it loses 27. Then it does 13, 15, and 11, right? Which is, a lot better than the steady portfolio, right? So, okay. So the average return of the volatile portfolio is 8%, right? But the real return, right, the geometric return is 6.15, okay? So it's compounding at 6.15. Okay, the steady portfolio, which has an average return of 7.6, which is lower than the volatile portfolio, but the compounding is 7.5. So in other words, it compounds at a higher rate.
Steady as you go.
The reason why is because of that volatility, right? The negative return eats away at the total, right? So that's the important point. And that's why Buffett says, I just buy the boring businesses, right? Because what he's doing is saying, I don't want any losses, right? I don't want any surprises where they go down 50%. I can handle it, but I don't want it, right? And so that's why he buys boring businesses like utilities, right? Their returns are not great. But what Buffett is really good at is saying this company's worth, overall it's worth, for example, $10 a share, and he buys it at $7. So he gets it really cheaply. It compounds at a high value, even though it doesn't do anything spectacular, right? That's what Buffett's really good at, right? He's really good at, and we're going to do something about the Buffett investor, right, and show people how to do it. But the point is he's really good at that stuff where you go, man, why would you buy an old railroad company, right? And it's because he understands price and value, and he understands that every year that railway company is going to be, it's just going to carry the coal and, it'll be fairly steady. It won't,
It's predictable.
Yeah, you won't get earnings like positive 28. Next year you lose 27. Well, if you lose 27, you've got to get about 35 to get back to where you were.
Yeah.
So just to put a dollar amount to it to make sense for people that might not be looking and they're listening. So starting value of both portfolios is $100,000.
Yes.
The steady portfolio finishes as at 143,861, and the volatile portfolio, which has a higher return on average, finishes at 134,000. So there's about a $9,000 difference over the 5-year period.
Yeah, that's over 5 years.
Yeah.
Right? So if you do that over 25 years, you end up with, I don't know, I'm just guessing, but you end up with 400 and the volatile ends up with 300.
Yeah.
Right? And that's why we say don't lose money.
Yeah.
Right? You've got to avoid that.
Compounding survives through shields, not just swords.
Yes.
Did you
Commentary
come up
down
with
them. Well,
Oh, it's on there.
no,
I thought that was just a thing at the top of your head. That was gorgeous.
dude.
Yeah, so that's
I thought of it at the same time I read it. Dude.
but that's a really important part because at the top of the market, like I was saying before with property, you get a feeling you're missing out, right? You get a feeling you're missing out. You get a feeling. And then if you start with 100 and you lose 50 to start with, well, you've got to get 100% to go way back to where you were, right? And that's not, that doesn't happen in 2 years, right? It takes a long time to make 100%.
Unless it's Bitcoin, Stephen.
Well, yes, of course. I mean, you guys are geniuses, but, that point, you guys are outliers, right? White swans.
That's it.
But the point stands, right? It's again saying to people, always focus on not losing money. And it's really boring, but it works, right? That's the thing that really works well. And that's, as I said, when you look at Buffett, he doesn't do anything that is not really, illogical. And he buys the companies that have got a competitive advantage, right? Coke, Bank of America, the railway line that he bought, Visa, MasterCard, Apple, right? But he buys them all when they're cheap, right? And that's why he knows he picks a company and then just says, okay, I'll just wait till the next crash, then I'll buy it, right? And that's the really, really important part, because he's buying it when it's cheap, even though it might have, like you look at Coke, right? Coke's not growing like Nvidia or even a modest growth stock, right? It's pretty mature, but it just keeps pumping out those cans, right? And
syrupy liquid.
Yep, sugar cells. But that's the thing, right? He just knows how to rebalance. He knows how to asset allocate, right? And he knows which companies to sort of will give him the best sort of return.
I hope when he does go that the legacy continues at Berkshire.
Oh, it will, mate. I've got no doubt it will.
Well, he started buying Apple in 2016. I just looked it up. It was about $20 a share.
Yeah, it was
at that point in time.
Yeah. Well, the
You're
other
kidding
thing,
me.
the other thing was too, Tom. You notice that if you look at, and this is another little clue, right? When you look at the quilt of returns for sectors, right? You know how we talk about it in Well too.
Yeah.
Buffett generally buys from the ones that are in the bottom, like we talk about.
Or rebalances into those.
Well, yeah. Well, Buffett opened his position. What have you got it up there, Tom?
According to Mr. Google, it said 2016, 2017. I'm going to pull open the quarter returns.
Yeah,
now.
because I'm 99% sure information tech was actually down the bottom that year, or close to the bottom. I could be wrong.
You're never wrong.
Well, I was going to say that. Once I thought I was wrong, but I was just mistaken.
You're wrong about being wrong.
That's right. So was it down the bottom? I think it was down the bottom in 216 or 215. I thought he started buying in
it's bang in the middle in 216.
Was it low in 214?
2012 it was low.
Yep.
And then it rose 28%, then 20%, and then 6% in 2015.
Okay.
It was in the middle in 2016.
Right. Okay.
Yeah.
So yeah, he's doing that with energy at the moment, and he did it with the commodities, right? When he bought the 5 Japanese commodity stuff, and then he bought Occidental Petroleum, and he's concentrated in that.
Yeah, but right? I mean, if you look in 2016 at Infotech, everything else above it was really high in comparison. Like energy was up 27, 23, 22.
Yep.
It wasn't an amazing year.
So it wasn't outperforming.
No.
Yeah. And that's what I mean. You know, like you just got to hand it to him. You know, like he's just stuck with that formula for 80, 85 years, right? He started investing, I think, when he was 10 or 11 or something. So, you know, I mean, it's
he's done all right.
Oh, he's such an outlier. You know, like you just look at it. I mean, Nassim Taleb says, well, you know, there's like 10 million fund managers. Well, you're going to get a Warren Buffett. And it's like, yeah, I know, but it's still astounding. Right? Statistically, you're going to get one person who's a 10 standard deviation, right? That's what Buffett is. But it's still astounding that he's done it.
Yeah.
Well, and he's done it for so goddamn long. I mean, he's compounded at 20%. You know, that's doubling your money basically about every 3.5 years. I mean, that's crazy.
Yeah, that's nuts.
Here's to you, Wazza. Well done.
Yeah,
mate.
cheers, was
Well
it?
done, Woz.
Happy birthday.
See you for number 96.
All right, that's it for me. Anyone else? All
No,
good?
I think that's pretty good. Look, there was a delay with the special, obviously, because we started recording it. It got corrupted.
Yes.
We've got to rebook a time, so I'm sorry about that. We've been promising that a couple of weeks now, but it's coming.
It'll be worth the wait. Tom.
Yep.
We were
Big
saying
time.
such terrible things it corrupted itself.
Yeah.
Anyway, thanks
Probably
to
for the
Two
best.
Hand.
Thank
Yeah.
you.
Thank you. And
Cheers, folks.
just before I wrap it up,
Hang on.
all
Announcement.
right? No. If you want to support us, go on the website, subscribe to the blog
Yeah.
and the week that was.
And read the bloody blog.
And if you listen to us on Spotify, please give us a like.
Yeah, and send us like $1 million or
Yeah,
something.
just have a hand out.
Yeah. All right.
Thank
Yeah.
you.
Enough.
Cheers, folks.
Bye.